we took the entire industry, which was the confusion of it, to say, let me classify this stuff, which is what the PowerPoint deck that you saw of classification. That process started for me like last year sometime. So we said that we're going to do Web 3.0. Question, we discussed Web 3.0 yesterday. This is the decentralization of compute, interconnect, and some of the other elements. So I classified Filecoin, BitTorrent, Stacks, Graph, Helium, Ocean Protocol, SIA. If you look at all of these things, they provide technology platform to enable decentralized exchanges. They are the layer 0 of sorts. So Helium, have you heard of Helium? Helium is disrupting telcos. So telco, you know how they have all these towers? Helium is building a low-ray WAN, which is lower range wide area network, by letting you host a router of sorts on top of your house and connecting that like in a web, bypassing, and that's much more bandwidth because it doesn't require microwave. And every packet goes through your house, through your network, you get coins from it. That's an incentivization mechanism. That's like a mining for them. So they're disrupting telco. So if you're in a city and the city is well equipped with Helium-like network, then you as a user can pay Helium and start doing massive data transfers, which in a wide area network is quite useful, especially between companies and campuses and everything else, which I think is a fantastic way to. So that's one example. Then you have Graph, which basically allows you to be able to curate your, AI relies upon curation of data. It relies upon modeling. These are people who can create the models, make it available to you to say, hey, I want to use that model. Let me buy a GRE token so I can use that model. And they're curating data and graph around it. So that's all Web 3.0 because all this, and same thing with Link, which is Oracle network. The premise of blockchain, as you know, is about trust, which means if there is a data that's coming from outside of the world, how do you trust it? So for example, if your smart contract says, which is a real world scenario, that I'm going to pay Katie bought a ticket, for example, and you have bought travel insurance, and let's say there's fog in Delhi, which happens quite a bit, and your trip gets canceled, then the DAO will have to then process a payment for you. And it's a common use case Alliance did. So you need weather data, you need airline data, but how do you know it's trusted? So you have oracles which provide the trust layer. So to me, all this was in Web 3.0. So not only I classified this token analysis, and you'll find a bit more revealing element of this, I have a supporting thesis. So why am I doing this stuff? What is the thesis behind me in creating a portfolio selection? So my supporting thesis say it's a foundational technology. It's fueled by layer 4, layer 3 growth, which means the more NFTs grow, the more storage requirements grow, the more networking grows, the more Helium-like technologies grow. So as layer 3, layer 4 exponentially grows, this will automatically be lifted, just like, dude, that's awesome. Can you play it? Is it a ringtone, or is that you're playing music?
No, that's Shivratri.
Oh, that's right, today's Shivratri, that's right. So how many of you are going to stay up all night? Who's fasting today? That's why you're eating fruits. Yeah. So no fasting? Oh my God, that's just disappointing. So going back to this thing, and by the way, thanks for being here. It's a holiday today. And I think we were discussing the scheduling with him. Says, it's a Shivratri. I said, that's the only day I have. And so, but anyway, it's a foundation tech. And as layer 3, layer 4 grows, you are then able to grow that whole thing. There's maturity premium, which means that it's raw tech. So what am I paying for? What of these projects are mature? Not all of them are, and I'll get to that in a minute. And there's liquidity premium, there's network effect, which means layer 3 cannot work if you have a centralized structure. Then you become an Amazon. So that's my supporting thesis. And I have supporting thesis for all of these entities. And I have a strategic fit, which means if I'm building a portfolio, and this all come together, so hang with me in there.
So how do you define liquidity premium here for layer 1?
I'll explain that. So strategic fit, long-term and medium risk. So the liquidity premium in this case is most of these assets, just like layer 1, layer 2, are liquid. But chances are they're not. So if you buy a Graph GRT token, it's not very liquid. When you're buying a Web 3.0 infrastructure, so for example, our storage example that we gave, right? When you buy storage, you can't sell it back it has a utilitarian concept to it. So there's a liquidity premium to it that you're taking the liquid assets and putting into it. That's right. So essentially that's what it is. So you're giving a premium to your liquid assets that you have, which means that the justification of making investment has to be big enough because you're trapping your liquidity in that investment. That's what that means.
Also, you mentioned how inventory, like a centralized network, cannot work in the
No, layer 3 can be centralized, right? For example, all the DAOs are generally start centralized. But layer 0, which is what Web 3.0 is, cannot be centralized because otherwise you would become an Amazon, right? The whole point of these, using the token for Band, Steam, Hive, Orchid, Link, they all require you to actually have a true, like Graph cannot work. If you look at the GRD token, which is basically curating your AI and your data curation that happens, it happens like, for example, you could have all kinds of talents around the world, and they find, like, same thing with Chainlink, oracles. You could have an oracle deploy on Chainlink, because Oracle lets you connect to weather data. Oracle lets you connect to external financial systems. Oracle lets you connect to XYZ. That's your specialty. So if you're a kick-ass guy who understands the capital markets in traditional finance, and you're expecting a trigger event, well, then you will deploy an Oracle, and you'll monetize it, because the more Oracle I use, I'm going to use the Link token to pay for it, and you're going to get Link token because I used the Oracle for that. That's the economic system they have. They build a sort of network. And again, the strategic fit, as I mentioned, is long-term and medium risk, which means that if I'm investing in this infrastructure, it'll take some time for it to grow. So I have to have some patience. And when you say medium risk, in most cases, these, just like anything else, these companies are making investment into infrastructure. So there's some residual value of that investment. Either it's a buyout, and that's happened, there have been some crypto buyouts. And so it's a medium risk. So long-term medium risk, and I'll tell you how the strategic fits work in what we call as an investment rubric. I have layer 1. The names here is basically what we divvied up in our team is you can only have so much time of a day between social media and your job. So you need to have some time. So we basically divvied up our specialty to say, hey, you go and focus on this, and I have specialty in Web3 or DeFi or whatever. So I have another research analyst who's looking into this to say, you go and, like stablecoin, I'm tired of it, but I do a lot of that work. So I said, go and research the stablecoin because I've done enough work. And I've asked her to do, again, things that I've already done, I've asked them to look into this. But interoperability is a big one. Atom, Dot, Ren are interoperability, this thing. And they have layer 2 considerations, growth of application layer. NFT will fuel the growth, foundation and exchange tech, and business interoperability are my strategic fits. So what I've done is, and some of them are, if you look at the strategic fit behind each of those, think of them as sectors in crypto, the crypto sectors. I look into it as a macroeconomic cycles, which is for layer 1, or interoperability elements, short-term macroeconomic impact, credit risk, long-term. So these are all the terms that I have used, and I'll explain what these terms mean in the rubric that I have, to say I have a strategy behind choosing, if I choose Web 3.0, this is my strategic fit. And I'm looking at this supporting thesis that has to be there. So if I'm looking at a balanced portfolio, for example, which I will show what I mean by that. These vernacular takes time to say, like TVL metric. If I'm looking at crypto capital markets, I'm looking at total value locked. And if a protocol doesn't have enough total value locked, what does it mean? So in this case, I'm looking at liquidity premium, protocol risk, TVL, fee structure, and I have all these. But let's say I look at Rune, Thorchain. I think you mentioned that, Shreyas. If they don't have enough TVL locked or enough sort of transaction volume, what does it mean? Come on. Shreyas, you have to answer this question, my friend.
I'm done with liquidity.
Yeah. No, it's not liquidity. It's more. Because you brought up Thorchain. Like, what does it mean? If you don't have enough total value locked. For example, remember the token economic system, right? So most of these capital markets and decentralized exchanges, what do they rely upon? How do they make money? That's right. They have a fee for every transaction they process. The more transactions they process, they get the fee out of it. And the fee is then distributed among the token holders. That's their business model for most of these guys. So if there's not enough token value locked, token locked value, then not enough fees, not enough structures, which means that the cost of doing business is not as attractive. Or if there's a massive drop in the indexes, which is what happened in Uniswap when SushiSwap came across. So you got to look at these metrics because there's a liquidity premium that you're adding to it. You're locking that liquidity that could be easily be utilized in layer 1 protocol, because layer 1 protocol is the most liquid protocols that you have here.
The price will go down.
Of what? But yeah, because fee structure goes down, the demand goes down, right? And so the question is, what are these protocols doing? And this is where AMM, does anyone know what AMM is here? What's AMM? Automated market makers. So you have market makers. Market makers provide liquidity, and they provide a ability for you to be able to match the trades of the demand and supply curve. And they provide sort of a fractional element, and jump trading is a perfect example of that. This is the company behind the wormhole issue around it. It's a very short marginal business. In many cases, they have to, the AMM marketplaces rely upon DEXs in some of these areas to provide automated market making function. An automated market making function, just like market makers, gives you that whole element of arbitrage, is ability for you to be able to shave off in different markets. So in most cases, many of the AMMs are connected to many DEXs and figuring out, which is where the element of yield farming. How many of you heard of yield farming? Right, so yield farming does, what is it? What's the business model of yield farming?
So you basically state what you buy and you get interest in return.
Yeah, basically they find the best avenue to maximize the profit you have, and yield farmings are quite expensive assets, right? So the question becomes, what is the business model? What is the risk? And so you have to look at this from a perspective of each of them have their own one token model. Some of them have two token models, which is the conversation we had with governance token and everything else. You have to have a supporting thesis. And this all comes into handy because this is all groundwork. You're not doing anything right now. You're simply putting in things in places because we as humans need a framework to understand, to classify, to organize so we can make choices. So you're building a choice framework for yourself where you have the DeFi, I have interoperability, asset management, derivatives, and this was in last July. And I will switch back in a minute, or actually I'll do it now. I did the same process in November. And I had this many more categories because of copy and paste. So let me increase the font size a little bit. Now, by the way, these are not all tokens that are available out there. So by doing this, there was a step before this. The step before this was I chose, this is just Nitin's perspective, on risk. So I look into most of these tokens, and I said a token should have, this is the rubric, a token should have at least the market cap of 400 million. They should be in business for 4 years. What that means is you're not a newcomer who has all the promise and you die down. I look at the qualitative metrics. Who are the founders? What's the background they have? Because they all have founders behind it. And more importantly, the trading volumes. Like, what is the demand supply curve that's happening in this space, and what is their business model? Which is a lot of research. And Masari makes it easier for you. Like, there are some things we can just open up and start looking into, which means is your ability to be able to consume information becomes faster because there's a massive volume amount of data you look at. So you have to have some mechanism that you can look at this term, say, okay, checkbox, 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 because there's no one has all the time in the world to read every detail of all these things are. So now from 7, 8 categories I had, there's like 17 categories. I have again Web 3.0, layer 1, layer 2, lending. I had to introduce NFT, which by the way, NFT is complicated because you have NFT platforms and NFT assets. What is the challenge with this, with investing into NFTs? Anyone?
Decentralized. The platforms are centralized.
Yeah, so the thing is, you're right. So some platforms are decentralized, but they, like say Solana is quasi-centralized, or Dapper Labs, whatever. But you have NFT platforms that give you an avenue to create, the whole cycle of create, publish, mint, transact, and exchange, and everything else. But you cannot, OpenSea or Rarible type elements, but you cannot invest into NFTs directly because they're non-fungible. The value lies in the eyes of the token holder. So how do I invest in Banksy or Beeple? How do I make a $9 million adjustment? Because that has to be equitable to your investment thesis. So my investment thesis is not, let me go buy the most expensive NFTs. So it is incredibly hard to invest in NFT as an asset class. But all this, as you know, is a platform. So Decentraland, Theta, Bake, NFTX, Rarible, Labs, Muse, Vax, Flow. These are all platforms. Some of them are centralized. Some of them are not. Right? Decentralized, they had the Mana, which is their token, and I invest in a company called Superworld, which is virtualizing the whole AR, VR experience. That today, a concert is happening, let's say, in Delhi, and I'm sitting in the US. I want to be in the concert. Well, today you have an avenue to go to a YouTube channel and see the live telecast. But what if I want to be there in person? Can I wear a VR glass? And can they expose an API? And because I own that piece of land on the virtual world, I'm paying rent for the location to, where does concerts happen in Delhi? My database is way too old. I'm of the Indraprastha era, so I have no idea. What is the stadium now where you have concerts? JLN, Jawaharlal Nehru? Okay, so JLN Stadium, let's say, has that. So you got to pay rent, right, to have the venue. But let's say I buy a virtual land in virtual world. So somebody has to host a virtual experience API on that. That's a business model. That for me to be able to use my Oculus and tap into that and be in person using a VR, I have to have some API that exposes and gives me that experience. And for where do you host it? Well, you can't go to a website because you're in the metaverse. So you actually go to this Delhi and find JLN and have their virtual experience there. That's the business model there. So stablecoin, DEXs, and this list has grown a lot too, as you can tell. That just in a matter of 4 months. This is 4 months. That's how explosive things were in 2020 and 2021. But not only that, asset management grew exponentially. Interoperability, as you know, I had 3. I had Ren, Atom, and Dot. Now I have Metronome, Shift, RAM, Komodo, OneChain, Arc, Keep, Ren, Quant. Again, interoperability has become a big focus because of the challenges that we discussed yesterday. Then you have other new ones, which I have, look at these categories, right? I have derivatives. I have gaming. Again, completely new class that has popped up.
Derivatives may be a subcategory of capital market.
It can be, yes. But the thing is, in terms of capital, the reason why I put a separate category, because you have derivative platforms who only do derivatives. And it's easy for you to also classify them as 2 separate, because one could be a security, one could be a derivative. One is a CFTC agenda, one is or in your case, a SEBI is both. But I think it's a lot of power they should always be separate.
It's trading versus investments.
Yes, trading versus investments.
And a lot of other segregations have also been done after this.
Yes, of course. I mean, you can go ad nauseum. Like even in derivative space, you can go after calls inputs. You can switch them into the various other risk factors that go into it. Then you have data management. This is again a new category. Like data has become a big part of Web 3.0. How do you own data? Data ownership type elements. You have enterprise blockchain as a service. These are companies who are not exactly permission blockchain, but they're selling to enterprise in a permissionless world, which is a whole different sort of category that has emerged. So GoChain, Nexus, Factom, Unibright, these are all sort of decentralized token-based models selling to enterprise, which historically companies like Microsoft, IBM, and Oracle sold Hyperledger Fabric for the longest time, and this is a new breed. And then you have miscellaneous, because I didn't know where to put them. But these are all companies which have 400 million plus market cap, have been in business, and have certain sense of maturity, that they were not just born like yesterday. So Gitcoin, Polka Starter, which is crowdfunding platform, Luxo, which is collectible, SOC, Handshake protocol. These are all sort of things. So, but more importantly, when you look at this stuff, they also all have an investment thesis, supporting thesis and strategic fit. So when you do this exercise, you're not just picking a lottery and saying, I'm going to go with this because this looks good. You need to know what is your thesis. It's an application layer protocol, which means short-term credit risk, microeconomic factors, long-term. So these are all terms which you'll see. I have built a framework, but I think I should switch to it now, which makes it all relevant.
I've seen you build the supporting thesis for each category.
So the question I ask is, again, why? Why would I invest in this class? What is somebody should have a thesis. So for example, if I look into, I'll pick one. Okay, pick one for me. Let's go to capital markets. So supporting thesis is it's an application layer protocol. So it's layer 4. Layer 4, as you know, doesn't have dependency on layer 1, layer 2. So it is sort of an application layer protocol. It is high risk. Why? Yeah, because capital markets. It has market challenge, but it also has regulatory risk. You know that these are individuals who can be like Uniswap was subpoenaed by SEC. So that's a big factor around it. It is a protocol risk. Why? Because we've seen with polychain, we've seen with wormhole that these are technical things that are still in maturity, which means they can be hacked, money could be drained, and that's a risk. It has a liquidity premium, which means that in most, with the exception of some asset, most of them have some liquidity premium, as you'll see, is that I'm trapping my liquidity, which are not exactly stable, which means that some of these, because the capital markets, they can fluctuate in value drastically, which means I'm trapping my liquidity in these areas and don't have completely liquid asset because some asset like wormhole situation happened, and if jump capital wouldn't have gone into it, it would have been hard to liquidate those tokens from that perspective. And then you have fee structure, TV, and metric is one of the other elements. Look into risk for a minute, and I'll show you what I built for risk model framework. So this is a broad level stuff. Now, before I go into the thesis, like the overall element, which is building upon what this is built upon, I looked into what others are doing, other funds. So before I build my own portfolio, I'm like, let me go and look. What is a common thesis? What are these people doing? The common ones, right? The CoinDesk, Bitwise. I have investment in both of these personal ones. CMS, NASDAQ, top 20 CMC, CoinMarketCap, for example. And I'll have you look at it for a minute. There is no rhyme or reason or thesis that I could determine. These are all dart and pick. Look at it. Look at any of this. Can anybody find a pattern? First of all, can you all recognize a ticker symbol before you find patterns? And if not, then we can move on with it, right? So for example, they went with top 10, the most common thesis you have. Okay, Bitcoin, Ether, which is staple of most tokens. Tether is liquid, which has problems. Binance went through an interesting challenge with regulatory elements. Cardano, XRP, Ripple, Doge. That to me killed the deal for them. Because as a fundamental investment, what does Doge do? If it's a meme coin, it's great. Let the speculators make money from it. But I'm not going to risk my investors' capital in this whole. So to me, the moment I begin to see Doge and USDT and some of the other elements, I begin to question, what are you doing? If I look into Bitwise 20, another interesting one, I see Doge here. I see Binance Coin, and I see Tron, Theta, Tezos, Elrond, Monero in EOS. EOS, we've gone through that earlier. So my question is, why are you invested into it? Is it a founder's personal thing with them? And if that's the case, then again, you're risking your investors' money because you haven't thought through this from my investment perspective. Somebody had a hands up? Yeah.
So can you take an example like suppose BTC?
Yeah.
According to your investment thesis,
Yeah.
what actually you look like?
Yeah, that's what I'm discussing here. I'm just giving an example of what others are looking at before I discuss what I look for in general. Right, and so then you have coin desktop assets. So I look at all this stuff and I start seeing Doge, XLM, red flags for me, at least from that perspective. Tron, I see GRT. I'm not able to find, at least with my naked eye, maybe there's a pattern here. What is a pattern here? I don't know what the pattern is. So that's one. Second thing I looked into is and this is my portfolio proposal. This is my portfolio that I built. And I can explain at some point why that's the case. But before I come back to this, it's a sample portfolio. You can take it and invest in it as you want, but this is, go for it. I don't care. And let me go back to this piece here for a minute. So you know how we discussed supporting thesis? Then we did another experiment. We went with some of the people in my team. Like I said, why don't we all do this? Let's go with collective wisdom, which is another thing. All people who get the industry well, myself, Matt, Derek, Jules, we said, let's go pick the top 10 that we like, for whatever reason. So they all picked, and you can see some similarities. BTC ETH is common in most of the cases. Aave and So we basically said, let me go and track this. And there's a thing called coinstat.app. So I basically took all this and start tracking in those apps to look at daily performance to get some history, because data is a huge issue around this space. So then we built, after almost the CIO, we said, look, I think we have a good idea. I just need you to give me a percentage points. So Mark, one of the CEOs, said, okay, fine. We now have this classification. This is in last year. Layer 1, layer 2. This is the initial classification that we had. And he's basically said that we need to have this allocation. So he gave me an allocation. And what you see you have longs and you have shorts, which is interesting, right? Because that's derivatives. You're shorting some of the tokens, so you need to have derivative markets to be able to do those things. There's another angle to this, which I'll tell you as a fund management, that's a challenge. But we looked at this and said, NFTs, we're only putting 3% because there's a hunch feeling. So we had this rubric where we begin to specify what the allocation would be, total exposure, total NAV, and we said we're going to put about 2 million in this whole thing. Which one? Yeah, that's right. The header is...
How do you do your asset allocation? How do you decide that amongst these 80
Yeah, so a bunch of those things. So again, the process works in a way that as a research person, we research the whole market and everything else. But the investment decision purely lies in the chief investment officer. There's a process where we all bring collective wisdom, and we have an investment proposal, and depending on who's managing the fund. So even if I'm a fund manager, I have to make a case with the chief, because at the end of the day, chief CIO's ass is on the line. Right? So we have to sort of make that case, and they have to then devise as to what they're comfortable with the allocation. So they provide the allocation. They gave me a high level. So target exposure, actual exposure, daily P&L. Does that make sense? You were looking for that heading, right? So I was given 14%, 0% layer 2, for whatever reason, and we have a thesis for that. We went to lending, NFTs, Web 3.0, liquidity for stable coins. So we're on just 5% of that, because that gives us enough liquidity to go in and out. We went to DEX, 14% with DEX, because they were pretty gung-ho back in the time. And that's the portfolio we got, and we basically then start plugging in the asset classes that we did, and we went back with that. That's a model portfolio that we built, and we were then tracking this for 6 months on that coin stat to look at the fluctuations of pricing, so we could get an idea of what market is all about.
So basically, you first got your broad asset classes done.
Yes.
Right? And then within that, you started choosing
Yes.
which ones.
Yes.
For that, what did you do?
Yeah. So basically, you have this big universe. It's continual process of normalization. You distill it down, you distill it down, you distill it down. So that big thing to say, let me limit this to, needs to be in business, needs to have certain market cap, needs to have this founders, qualitative, quantitative, the small world. And then we basically distilled it further down based on, first iteration was collective wisdom to say, what are we all commonly feeling good about because of our industry awareness. In second iteration, I refined that a little bit more in terms of some of the betas that we need, and I'll explain that when we go into that portfolio construction that we have, which is the sample portfolio. This is still happening in July. So remember I discussed this yesterday, the 4 layers. So that is one part of the blockchain layers. But then also have the DeFi layers, which allows us to explain to investors what is the rubric, where are we investing, which means you're just throwing money at token, exactly what I showed you with CoinDex top 20. It's easy to go pick top 10, top 20 and say, let me go throw money at this. Investment style. We just said this is where we are. These are all equity companies, which means they're a traditional VC investment, but these are all token companies. So, question?
So when Bitcoin starts losing a lot, so on the coins get further.
Yeah.
So like in many of these coins, they never outperform Bitcoin, which is bad. So like compound is not performing. So if you don't get in like early into that, and you know,
True. Yeah, so you have a long short. So if you remember, there's a supporting thesis, but there's also this other element, and that's the asset mix that you're talking about. That's a really good question. So you have the strategic fit of midterm, long-term, short-term around it. Now the question that you asked is, this is the matrix. So we don't just blindly pick assets. We pick into terms of what kind of matrix you want to build. So if you want to build a balanced portfolio, then you need to be equally distributed. It's like an index type fund. Sometimes you have a conviction of going. So for example, I look at so this has a paper behind it, so it's a lot of work. But if you look at one picture, this paper describes the picture. I wrote this like last year, that you have risk model for maturity and investment strategy. So remember, we had the supporting thesis and the investment sort of risk that we had. So I look into low maturity, and risk model is low, and risk model is high. I look into investment strategy, short and long, and I basically created a matrix. So to me, red are red flags. So compound is a red flag. It will go into the second category of DeFi market infrastructure and native crypto assets. They were red flags. Now, as an investment manager, just like Kathy Woods and ARK would say, I believe in it. I'm going to go with it because I expect that downward trend eventually to come back up again. That's your call. That's a risk that you make, and that's what you sell to investors. There's no perfect answer. If you all had the answer, we all be making money at the same time. But this one helps me formulate the narrative. So to me, green is, dude, we got to do this. Orange is, let's go through investment committee to do this. Red is, unless CIO wants to do it, I'm not going to do it. Right? Or we all have to agree on the risk that we're taking, or let's do high risk, high reward analysis, put them into 5% of our portfolio to do this. So color coding to me just helps from that perspective that investment strategy is short, maturity is high. I'm going to use this as a high frequency trading type piece of my portfolio, but this is going to be long that I will not touch. And the question then which CIO should help me is the balancing model. To have enough liquidity in stablecoins, which is still high yield, still contributes to 6 to 8% to your overall portfolio, gives me a long-term perspective. This is the long and short piece that you saw in the other one. And then you have a small little pool that lets me go in and out of the asset as I see momentum and trend sort of have the upward curve in the market. That makes sense, which means that if you have compound, you have two options. Either you can have a short asset to balance that out, or you have an asset that counters the compound's effect. And that could be a stable coin by itself, or it could be a CDP, an alternative CDP like an Aave type stuff, or hedging your bets. Now, if I have, again, this is where efficient market hypothesis comes to play. If I have some information that I have because I have figured this out, whether it's data or whatever, then I'm going to say, hey, I'm going to all Web 3.0. I'm going to call my fund Web 3.0 because I have some information that's gone through that. Does that make sense? Yeah. So this matrix, it took me almost 3 months. It looks like a simple, it's a lot of work just to be able to digest these things. But you write a paper about it first and say this, and then you put it here because no one reads it. This explains it a lot better than 4 or 5 pages behind it. I charge a fee for that. That's not free. I'm just kidding. So basically, red. So like just like traffic lights, your red is around. Is taking pictures. Is going to give me royalty. That thing has a smart contract. It puts it out. But the thing is, you have green is something which has a long tail play, and its maturity is high, which means like Bitcoin, it's mature. I'm going to go long tail on it because I believe that's going to happen. Like Blockdaemon, Blockstream, they're going to be in business because they have massive investments from the community that they have to survive, which means if I don't believe in those long plays, I might as well quit the industry, right? Then why are we doing this? Why are we in crypto? So you have to have that long-term perspective, and same thing with low maturity but still long play, because this gives me that continual upward curve. It'll have short-term blips, but if it's a long-term play, then it's still low maturity, which means as it matures, I'm going to take advantage of the maturity curve, the upward curve.
Coins cannot come in that order, only like what themes can come in the
No, coins, what themes are linked to the coins at the end of the day. For example, DeFi market infrastructure, mid-tier payments, stablecoin and payments, digital asset custody. These are all, like most digital asset custody business is not tokenized. Fireblocks, Copper, you have to pay them a fee. They are what we call here So these companies, no, they don't have tokens. They're supporting infrastructure. They all are traditional VC companies. They provide services. So some funds, not our funds, we just do it with tokens because it's easier operationally. Some funds have a model which lets you do half token and half VC. Yeah, invest in startups, but some do invest in tokens. Some do in tokens, they have liquid assets and they keep moving things around depending on how they see opportunities. It's a little bit more complicated. It's a hybrid model between crypto capital markets plus VC. So they both have a different time and return horizons, as you can understand. So it's a little complicated, and I didn't want to get into that. Question?
So that matrix which you showed, it can change from person to person.
Yeah. It can, but you have to have the narrative behind it. So you can say, hey, Nitin, I don't agree with this. Stablecoin should be in the low maturity model. And I'll say, fine, go do it. But being in the industry, I think stablecoin is mature enough that I have an institutional account with USDC. It's mature enough. I'm verified. I use it for payments on a regular basis. I'm a common guy. So you're right, it's subjective. But as long as you have a narrative behind it, right? Which means I wrote this with my experience and my team, and we all agreed upon this, and we had opinions, and we incorporated the opinions into the whole thing. But that's what investment is. I don't think there's no black or white. We come with a belief system. There's no straightforward blueprint to say, go follow this. Same with this. It's low maturity for DeFi instrument, wave one of CDP lending, tax KYC. It's still like no one knows what the tax code is going to be. So how are you going to make a deterministic call on a protocol or a coin that's going to help you solve tax problems? Well, tax code is not solved yet. Same thing with collateralized debt positions. So Maker was the first one, but it's still not maturing, right? It's still in the process of maturing. Wave two for risk level, which is mid-risk level. So all you see in orange is the subjective statement again to say, I'm going to go mid-term on this. So if I put money into this, it may be 3 months, 4 months, 5 months. Bitcoin, it could be a year. Some of this could be a week. But remember this, when you construct a fund, most fund managers, they simply invest and they forget. And they reevaluate every week, every month, figure things out. And that's a good investment style. There's some people who are active investors.
What is medium term, short term, and long term?
Oh boy, that's a crypto space. Short term is like a minute. Just joking. I would say short term is a couple of days because of the fact that it's very volatile and things move really fast in the space. Long term to me could be 3 months and more, a quarter. Yeah, and I think quarter is a good way to evaluate because you have other macro factors like economic reports, employment reports, the FOMC meetings that happen every 45 days. So it gives you enough metrics because they do affect the liquidity coming into the space, right? And so you're right, it's a bit subjective, but you have to have a narrative why you put them in those categories. And having this gives you like a Boston Consulting Group quadrant, which helps to justify it. So this is a second process. So again, vast universe, distill it down, have your supporting thesis assigned to each of those, like why would you pick those assets? This is the next step in the process that allows you to be able to tie in terms of, what quadrants you want to choose. So right now, all I'm doing is communicating narrative, helping our CIOs make decisions, helping the process work itself out. And then you have the research metrics, which means now that I have the framework, I have the investment matrix, I have the investment rubric, how do I analyze this? So now I have technical analysis, I have fundamental analysis, I have transaction analysis, financial metrics, and risk model considerations. Unlike typical qualitative and quantitative model where I simply crunch numbers and look at predictive models, crypto is a little bit more different and interesting because you have to look at the moving averages because the market never sleeps. There's no open close. It makes it enormously challenging. We look at stock to flow, especially for layer 1 protocols. We look at market value to realized value ratio, network value to transaction value ratio, moving averages, Bollinger Bands, simple moving averages, exploding. And the reason for some of these things are simple. How do you asked me your opinion for Ripple, and I gave you a long-winded answer. If I look at a token from a network perspective, what is the realized value? How much are these tokens being traded back and forth versus what's being realized in terms of the value that token creates? So that's what it is by some of the metrics around it. The market never sleeps, so there's no open close.
We find a value. I mean, we do concepts like value versus price. So
Yeah.
how do you value it? I mean, that's
Yeah, so this is the next step. So that's right. That's the next step is then the process. So once you have those metrics, you put in the numbers, and now you have companies like Total Terminals and like entities who will give you some data. But remember, this is the hierarchy of data, hierarchy of needs, and granularity of data. The most, from a trading perspective, this is all quantitative data. Any comments? Take it, man. Take a picture. It's all free. Knowledge is free.
You can share this experience.
I can't. I can't. For this, I need a couple of ethers. This is not going to be free. I'll sanitize and share it with you. I'll share this. This is not. I've written on this topic, so happy to do it. Even better, connect with me. And I have a weekly podcast. We talk about all this stuff all the time. It's 30 minutes of investment time. When you're running, jogging, fasting in Shivratri, do that whole thing. Or making gujiyas.
So what's the name of the podcast?
Beyond Bitcoin. We bring specialists, we bring our researchers, but we only do it 30-34 minutes. Bring layer 1 founders, we like what's your process, because it's all intellectual sort of evolution around it, right? So I listen to, I have my own podcast list, NLWs, and for example, and Frank Shaparo. Do my running, that's what I still listen to music. That era is gone, no time for music anymore. You have to use all the time to learn crypto. But the challenge with this is quantitative analysis, where you have all this data that you can get from layer 1 protocols, which is what everybody does. So this data is cheap. It's vast, a lot of volume, a lot of veracity, but it's cheap. You can go to blockchain networks, you can go to asset exchanges, Coinbase makes it available for free, maybe CoinDesk and WazirX does it too, and you basically take all the data, create AI models, or put them through a spreadsheet and do all this stuff. This is free. As you keep going up, you're getting into refinement. You're getting into market data, on-chain data, looking at data, then now you begin to see things like oracles. You see Kaiko, for example, another company which is French-based, that's basically saying, it's a lot of information, let me aggregate this for you and give you the things that you need as a fund manager. Of course, you pay for it. So it's build versus buy type structure. And of course, you have this, which is very specific, reg and comp, which we'll not discuss here. And then you go into digital asset research. This is where I am at the moment. In the sense that it's a process. We did this stuff. This can be achieved easily, but doesn't give you information. Everybody has the same information. So the question then becomes, how do you do? That's your IP too. So it's a hierarchy of needs. So you're on the top of that. That's your need to get more and more involved and understand this piece. So then the question becomes what technology do you apply? So you need some really smart, kick-ass people who understand data scientists. And so we have like 2 people who are looking into this from time series perspective, looking into indexes and how can we beat the index and removing the noise and signal. And we actually have a model which picks, based on that thesis that we have, it automatically picks like 25 top tokens. And I pick manually too. So I pick manually and the algorithm picks 25 and we match the two. And we had like a 67% match of what the algo picked and what we picked. So to me, it's an amazing journey because now you're able to say, okay, you know what, I'm maybe on the right path here. Not that I trust the machine, I trust myself. But is that journey that you go. And in terms of granularity as to what kind of data you need, OHLCV, exchange rates is all easily available data. You have to start paying for this data. So as you move down the path, quantity price trading and traded data, which is if you're a customer of an exchange as an operational element, you get access to the data. But as you start moving in terms of order booking, order book data becomes the real market data at that point, because now you have access to what's trading, what's in the pipeline, what you need to short, what you need, like you begin to start seeing. This goes back to Flashboy days, where I know exactly what's coming in, what's going out, and I can get ahead of the ordering system that goes into the whole process. So that's the data need, which is what we need to do from that perspective.
How do you get access to order book data?
You have to pay for it. Unless you're running an exchange, then that's their business model. So most exchanges and most of the Bloombergs of the world sell that data. You don't need to have a research framework. It's not accident. You just don't go about reading a billion pages and say, okay, this is my research. So what we do, the first page, remember distilling down all the stuff we discussed, layer 1, layer 2, that's all foundation. You have to just know the industry first. And then you look into initial research, which is, as you have seen the process, we have distilled the token down based on the broad level, which means I may not know about Rune, for example, but I know Rune meets my criteria of 4 years in business, 400 market cap, and everything else. And then I do initial research. Then I go into choice architecture. So if we come down with, let's say, 120 tokens, we look into sort of analyst POV, founder interview, which is the portfolio that I've shortlisted. So if I've shortlisted Web3 or 15%, whatever it is, then I will have a choice architecture to say, instead of Bitcoin, you have these are the choices, which are the same metric as Bitcoin. But Bitcoin is like, so that's the choice architecture, which means that in every category, I have a prime asset that we all would like to invest, but then I also want to have alternatives, and I want to be able to create these other elements. And then you have qualitative analysis, where I look into code depositories, I look into how much people have deposited code, how many people are working it, how big is the community, who are the founders, and then we give a trade proposal to our CIO, that's token 1, token 2, token 3, this is what I propose for approval. So you have some method to the madness. You're not some going out there and just buying the tokens that you like. But all of them also has an operational constraint, which will happen after, I'll discuss after lunch. Then you have the framework where we do the crypto sector research and analysis, which is the top-down approach. Yeah. And then we give fundamental analysis and technical analysis, which you saw in those pictures that you took of the metric. Then you classify it. Classification is important. Why? Why is classification important?
Classification of what?
Classification of the tokens that we did, right? Classification into.
That's an asset allocation.
Yeah, it's a structure. Otherwise, how do you make sense of what you're putting money into? Just like Dogecoin. I don't even know where to put Dogecoin in the whole ecosystem. Yeah. And then you look into crypto asset collection, which is a collection of all the assets that you have in each classification. Then you perform the same process that you have done at a high level, at a sector level, to the token level. Then you create a tabular form, and then you build the risk model framework, and then you make the investment. This is the methodology we came up with. The reason why this is important, because why would you want to do this? I mean, I could have just said, guys, buy this for. Why do we do this? That's right. You have to explain this. That's brilliant. It is. It's pretty good. It is true. I mean, that's exactly what it is. You got to tell your investors that we have a method to this madness. If you're doing this, and this is the method we chose. Now, you can change it, but we chose this method. You can do what you want from that.
How you came across deciding your investment style?
Personal or fund?
Fund.
It was a collection of, so that's a good question, right? So most companies have multiple funds. So first fund we did was fund of funds. That's no-brainer. You pick the top, like Pantera Capital, and you pick 4 or 5 and say, okay, I'm going to invest in those because they're handling the risk and they're taking their fee. And you simply diversify enough. And second was index. And you pick an index and you put into it. Third one was, which is more work, when you start getting more like granular and picking a DeFi fund, which means you're focused on decentralized financing. I'm not saying we don't do Web 3.0 or NFTs, because NFT can also be financed. You can financialize NFTs from that perspective. So our thesis went down the fact that depending on the fund, you create a broad level thesis of what the fund should do, and then this all follows. So this is for one fund.
Yeah, so typically the traditional finance funds, we typically have factor investing, so we have styles like value, momentum, growth.
Yeah.
So we follow one of those
Yeah.
to create a fund.
Yeah.
Is there anything of that sort?
Yeah, we do. I'll show that to you. And that's in our calculus. But in this case, we look at DeFi fund, and most of these are uncorrelated funds. Only because if we start going to traditional model, then the expectation is traditional too. You know, so we look into value momentum as a part of a calculus, but we don't make it a value fund, which some crypto people do that. They just make it a value fund. But I think it's too early to classify momentum and value because we don't know what these tokens are doing half the time. Yeah, I know. Doge is up there. So what is Doge? A value, investment? What is it? Payment?